25 real estate terminologies you should know to be successful in the industry. Clients want to work with more experienced people in real estate, and we shall help you with that. We have 4 groups of real estate terminologies. 1. Financial and documentation. 2. Listing and property info. 3. General real estate terms. 4. Offers and contingencies. Let's start with A. Financial and documentation. 1. FHA 203K rehab loan. This is a fixer-upper loan, which combines the mortgage loan with a loan to help pay for repairs or updates, such as structural repairs or energy-related updates. It is not intended to lend based off of luxury upgrades such as adding a swimming pool or tennis courts. 2. Seller disclosure. A seller's disclosure is a disclosure by the seller of information about the property, or which could affect a buyer's decision to purchase the property, all of which to the best of the seller's knowledge. A seller must also indicate items which are not specific to the property itself but related to a person's enjoyment of the property, such as pest problems, property line disputes, knowledge of major construction projects in the area, military base-related noises or activities, association-related assessments or legal issues, unusual odors caused by a nearby factory, or even recent deaths on the property as permitted by law. 3. VA loan. A VA loan is a loan guaranteed by the government, Department of Veteran Affairs, and available to the military, active and retired, and even for some eligible spouses, at low to no down payment scenarios with competitive rates and fees. 4. Earnest money deposit, EMD. This refers to a good faith deposit. It is the initial funds that a buyer is asked to put down once a seller accepts the buyer's offer. It shows not only that the buyer is serious about buying, but that they are also willing to put their money where their mouth is. The amount of the EMD can vary between 1 to 5% of the sales price. The EMD is often held by an escrow company, provided for under the Purchase and Sale Agreement, PSA. 5. Equity. This is the investment a homeowner has in their home. To calculate equity, take the market value of the home and subtract any mortgages or loans against the property. The amount left over is the amount of equity you have in the home. 6. Debt-to-income ratio. Debt-to-income, DTI, ratio is a number used by mortgage lenders which is determined by the total of your debt expenses, plus your monthly housing payment, divided by your gross monthly income, and multiplied by 100. This helps lenders determine affordability based off of their available loan programs, and allows them to estimate how much you can afford to pay monthly for a mortgage. E. Listing and property info. 1. Tenancy in common, TIC. Tenancy in common describes a type of joint ownership of a property, whether a single-family property or a commercial building. The tenants in common all own the property, but in different ratios. 2. Real estate owned, REO. Real estate owned is a designation given to properties which are owned by a lender due to an unsuccessful foreclosure sale at auction. REO properties can sometimes present an opportunity for a buyer to be purchased for below market value, as most banks would prefer to reinvest the proceeds, rather than waste time marketing the property for an extended period. 3. Conventional sale. A conventional sale is when the property is owned outright, has no mortgage remaining, or the owner owes less on their mortgage than what the market indicates the owner could sell their property for. Such conventional sales are often smoother transactions than non-conventional sales, such as foreclosures, probate-related sales and short sales. 5. Land lease. Traditionally, when you purchase a home, you own the home and the land the property is built on. There are some circumstances that involve a land lease, which means you would own the home while paying rent to the landowner for the land. E. General real estate terms. 1. As is. A property marketed in as-is condition usually indicates that the seller is unwilling to perform most if not all repairs. It could also mean that it is priced as is, which is typically lower than market pricing in the area. 2. Closing cost and assortment of fees charged by a lender, the title company, attorneys, insurance companies, taxing authorities, homeowners associations, real estate agents, and other closing settlement-related companies. These closing costs are typically paid at the time of closing a real estate transaction. 3. Due diligence. This is a time frame provided to a buyer to fully examine a property, often by hiring experts to inspect the property, perform tests, so that a buyer may decide on how to proceed. It might be available in the purchase agreement. 4. Days on market, DOM. DOM is defined as the number of days from the date on which the property is listed for sale on the local real estate broker's multiple listing service, MLS, to the date when the seller has signed a contract for the sale of the property with the buyer. A low average DOM indicates a strong market that favors sellers. A high average DOM signals a weak market that favors buyers. Seasonality can also be a factor. Homes generally appear to sell faster in spring than winter, since you often have more people looking to purchase and sell during the more pleasant weather months rather than the colder, more uncomfortable weather months. 5. iBuyer. This is a company that uses technology to make an offer on your home quickly or instantly, as the term implies. iBuyers take on the burden of owning, marketing, and reselling your home. Depending on the service you choose, the benefit is the certainty of an all-cash offer and more control over when you move. IV, offers and contingencies. 1. Appraisal. An appraisal is required to gather the estimated value of a piece of real estate. During the home sale, the mortgage lender sends out an appraiser to get a professional opinion of the value of the property. This helps the lender decide if the property is worth the amount of the loan the potential buyer is seeking. 2. Backup offer. When a buyer is interested in purchasing a property that is already under contract with someone else, that buyer has an opportunity to submit a backup offer in case the first transaction falls apart. A backup offer must still be negotiated and any monies, such as earnest money, submitted, to confirm it is the next offer in line. There can only be one backup offer legally, as you cannot have a backup to the backup. 3. Option period, Texas only. A termination option period, known as option period, is a form of a due diligence period. However, it is only available to a buyer who separately purchases this right for a negotiable amount of money and for a negotiable period of time. When a buyer has purchased this right to terminate, they are strongly encouraged to get all of their inspections and other due diligence performed during this option time frame, although doing so during this timing is not required. If the buyer chooses to terminate the contract within the option period, then the earnest money shall be released back to the buyer. 4. Loan contingency. A loan contingency is a clause or addendum, also known as a mortgage contingency, in an offer contract that allows a buyer to back out of a deal and keep their deposit if they are unable to secure a mortgage with specified terms during a fixed period of time.
You smart. You very smart. We the best. You a genius. I appreciate you. You loyal. I changed a lot. You can too.